Hello, it's Andrew with Homes Mortgage Lending, and today I'm going to talk to you about mortgage escrows. There's a lot of confusion about the math that goes into setting up an escrow account with your mortgage, so I want to go into some detailed example and give you some information about how the escrow is set up that will hopefully make it make a little more sense to you when you're looking at your numbers on your final closing disclosure or just later down the road when you're reviewing how much money is in your escrow account. So first, let's talk about the tax bills. Even though you're escrowing for property tax and homeowners insurance, you're still going to receive the property tax bills in the mail. Typically, you're going to receive, you have two tax bills, one in the summer and one in the winter, so you're going to receive one tax bill in the summer and one in the winter. Those tax bills are also getting sent to your mortgage servicer, who is going to pay them on your behalf from your escrow account. So you don't need to worry about the fact that you're receiving those tax bills. Your mortgage company is also getting them, and those are just more of an FYI for you. You only need to be concerned if you get a late notice. So if you get a late notice, that means the mortgage company didn't pay it, and you want to contact your mortgage servicer right away to see why it didn't get paid, what's going on. You do want to keep the tax bills for your records. They're kind of an FYI for you, and they're also going to be something that you'll likely want to provide to your tax preparer, as property taxes are deductible on your personal income tax returns. So escrow setup. Here's the basics. Your mortgage company, is going to put enough money in your escrow account to pay property taxes and hazard insurance when they're due. Pretty basic, makes sense. The math is where it gets confusing. The math is based on your first payment date for your new mortgage and the future date of taxes and hazard insurance. So I'm going to give you an example here in just a bit. There's also going to be reserves collected, so we know property taxes and homeowners insurance typically don't decrease, they typically increase, so we put some reserves in your escrow account too to account for future increases. And there are some government regulations about the math used to set up and maintain an escrow account. It's actually very regulated. The math's pretty standard, for better or for worse. So in general, I think the math makes sense, but there are some components to the rules of setting it up that can make things a little bit funky and not make common sense. So I'll talk about that in a little bit more detail later. So let's get into an example. So let's say that you just bought a home and you closed on April 15th. The first payment due date is going to be June 1st. So you don't pay your first payment the first of the following month, you pay the first of the month after that. So you don't make a payment in May. Let's say the hazard insurance was $1,200 per year. One thing to note is you'll pay your hazard insurance premium for the full year up front, and then we're still going to collect for hazard insurance in your monthly escrow. So a lot of times I hear people say, well, hey, why are you collecting for hazard insurance? I just paid a full year of hazard insurance. You don't need to collect for that. Well, we did, but we're also going to need to pay the next year up front, a year from when you got the first year's hazard insurance. So in this case, if your hazard insurance is good for April 15th of the year you bought the home until April 14th of the following year, well, April 15th of the following year, you got to pay for April 15th to April 14th of the next year. So when the tax bill will be due, we need to have the money in the escrow to pay for it. Summer taxes we'll assume is $2,400 a year due July 1st, and winter tax bills we'll assume is $1,200 a year due November 30th. So the monthly escrow in this situation would be $400. So for the property taxes, we're collecting $200 for summer, $2,400 divided by 12, $100 a month for winter, $1,200 divided by 12, and then $100 for homeowners insurance, hazard insurance, $1,200 divided by 12. So I purposely picked these numbers to make the math really round, really easy. So at closing, with this scenario and that closing date, we're going to collect about $3,000 in the escrow account. We're going to collect 11 months of the summer tax bill. So we're going to collect almost the whole thing. So again, your first payment is June 1st. So of that payment, $200 of your escrow amount that you're paying each month is for the summer tax bill. Well, we know that on the following month, you're going to owe $2,400 roughly for that summer tax bill. So we are $2,200 short, so we're going to collect $2,200. Similar math with the winter tax bill. We're only going to collect 6 payments before that winter tax bill is due on November 30th. So we're going to collect $600 for the winter taxes. And then we're actually going to collect a couple months worth of homeowners insurance, because even though you paid a full year up front, your first payment isn't until June 1st. So in order to have $1,200 in the escrow account by April 15th of next year, when that homeowner's insurance will need to be renewed. We need to collect a couple $100 up front. And then we're also going to collect reserves, as I mentioned in a previous slide. Typically, we collect 2 months worth of property taxes and 3 months worth of homeowner's insurance, so that breaks down to $900 in this example. So total we're going to collect is approximately $3,900. And then I also want to point out prorations. So prorations don't actually, they're not escrowed, but it kind of coincides with the math of the property taxes. So prorations are either a charge or a credit to the seller. So if your property taxes are paid in advance, you're going to owe the seller some money because they already paid property taxes for part of the time that you're going to be living in the home. And then if they're paid in arrears, then the seller is going to move out of the home, and the property tax bill that is going to come due is for part of the time the seller lived there, so they're going to owe you money. The breakdown of this in Michigan is typically in Southeast Michigan, property taxes are paid in advance, so usually you owe. On the west side of the state, they're usually paid in arrears, and then there's some one-offs, and as you get to the center of the state and up north, it's kind of a crapshoot of which way it goes. So you need to work with a lender that's familiar with your area, because if they miscalculate this and think you're going to get paid money when you owe money, it's going to throw your numbers way out of whack, and you're going to need more money to close that you weren't expecting. The way that the math works for this, I do most of my loans in Southeast Michigan, is that the total ends up being about a year's worth of property taxes between the escrow setup and the prorations, not including reserves. So in this scenario, you're going to owe the seller back about $600 for the winter tax and about $200 for the summer tax. So another $800 is what I would expect the prorations to be roughly. And that's that math equals a full year's worth of property taxes for summer and winter. So when you have your loan, you're going to have your escrow analyzed by the mortgage servicer, typically on a yearly basis. They can do it more often than that, but they're required to do it at least once a year. But that first escrow analysis doesn't have to happen within the first year, and I don't understand exactly the nuances with it, but sometimes it happens at month 14, month 15, month 16. I've seen it where that first escrow analysis happens. And the reason that is important is because if you've already been working with me, you've probably seen that on fee worksheets when you're looking at homes. I'm sending you an estimate of property tax increases, or if you just closed on a home and you're watching this, you know about what we're estimating the property taxes to increase. So when we set up the escrow, we're setting it up on the property taxes that the current owner is paying at the time you close, and we don't adjust for what we think property taxes are going to increase to. This is kind of the rule that I think isn't really that smart, but there's some government regulations around it. So it's very much the norm. There's very few exceptions where you're going to set up the property taxes based on the current property tax rate that the current owner is paying. And what ends up happening is, in most cases, the home value has increased, oftentimes substantially, from when the current owner bought it. And there's caps on how much their property taxes can increase each year, which is a great thing, especially now that you own the home. You want those caps in place too, but those caps are removed and the home gets reassessed the first year. So a lot of times there's a big property tax increase that first year. Well, if we're only collecting for the property taxes that the current owner paid, and then the new property tax comes out in that example in July, and then in November, or really in June, and then October, but they're due in July and November. When those increase, we don't have enough money in the escrow account because we didn't collect enough. So it's important to have an idea of what those taxes are going to increase to and budget for it. There's a couple things you can do. Again, the escrow shortage is common the first year when the property taxes increase, and it will increase. You'll know about the escrow shortage, and you'll get a payment increase for both the property tax increase itself and the escrow shortage when the escrow analysis happens. And because we don't know exactly when that's going to happen, there can be some, the math can get kind of messed up based on that, and I'll talk about that here in just a second. And then there are maximum amounts that can be held in escrow, and the reason that I bring that up is because oftentimes when I talk to clients, they go, hey, I know the escrow is set up based on the current property tax rate, but I want to plan for it. So what I'd like to do is, we estimated property taxes are going to increase $2,400 a year, $200 a month. So I would like to just put $200 extra a month in my escrow account. You can absolutely do that, but there's a couple things you need to be aware of. One is that you want to make sure that that money is going into your escrow account. If you just pay $200 extra a month, typically it's going to be applied to principal. So you want to talk with whoever your mortgage servicer is, and make sure that you know how to put the money in the escrow account, not towards principal. And the reverse of that is also true. If you're planning on making extra payments to your mortgage, you want to make sure it's going towards principal and not into the escrow account. Because I've had that happen with clients too. So just make sure that you're having that conversation with your mortgage servicer so that you know how that money is going to be applied and that it's being applied where you want it to. The other issue is that when this escrow analysis happens, the property taxes might not have increased yet when they do the escrow analysis, or maybe only one of the two have increased. And if there's more money in the escrow account than is legally allowed, there's rules on how much can be in there based on what the current payments are. If the percentages are too high for what's in there, they're going to cut you a check for the difference on that calculation. So if you get a check back, I've had this happen to clients where they put extra money in the escrow account. Taxes increased a little bit because maybe just the winter tax increased, and then they get some money back and they go, oh cool, the property taxes didn't increase by how much we thought they were going to. Now they're no longer budgeting for higher property taxes, and they spent the money from the escrow refund because they think they're all good. Well, the following year they get another escrow analysis, and now the summer tax bill also increased, and so there's another escrow shortage that they weren't planning for. So my advice is to keep those property tax bills so you have an idea of which tax bill increased. If only you see an increase on the winter or the summer, whichever one you get first, know there's probably another one coming. And if you get an increase on your mortgage payment because of the tax increase, you're probably still getting another one, unfortunately. And then also I recommend just doing this if you're gonna budget for a tax increase, which I think you absolutely should. Then I think that you should do that on your own. Put it in a savings account, put it in a high yield savings account so you make a little interest, because in your escrow account you won't get paid any interest. And that way you don't have to worry about the escrow analysis messing things up and they cut you a refund check. Then you have to decide, do I put that money right back into my escrow account? The math's a little bit goofed up. So having it in your savings account makes it easier. And then when you get your mortgage statement and the payment's gone up because the property taxes have increased, you can call your mortgage servicer and ask them how much the shortage is and pay it off right then, so that the shortage drops off and only the payment only increases by the actual amount that it should based on the new property tax amount. And you can even ask them what tax bill increased at that point, so you have an idea if you're going to have another increase down the road. You don't have to do that. Almost every mortgage servicer will allow you to catch up an escrow shortage over 12 months. So when you hear someone say, hey, my mortgage payment just went up $400 a month, they probably weren't planning for the property tax increase at all, which is unfortunate. But their property taxes probably only went up $2,400 a month roughly, and they're paying $200 more a month for the property taxes. But they probably had an escrow shortage of another $2,400 because they were collecting money for the lower amount, and now they have that negative $2,400, and the mortgage company just divided that by 12 and said this will get paid off over the next 12 months. And if you want to do that, it's an interest-free loan basically. If you'd rather just pay it off on a monthly basis and not pay a lump sum when the escrow shortage happens, you absolutely can. It's really your preference, but I've found when I talk to most clients, they'd rather budget for it up front and plan for it and just pay it off when it happens, so that their monthly mortgage payment stays where it should be after the tax increase. So I hope this is helpful. I know this stuff is confusing. Escrow math is one of the most confusing things, if not the most confusing thing, when it comes to trying to understand the finances and the numbers behind a mortgage payment. If you do have any questions, please let me know. I'm licensed anywhere in the state of Michigan, and as I mentioned, there's some nuances with where you're buying the home to make sure that these estimates are correct up front when you're planning for how much you need out of pocket when you're buying a home. So reach out to me. I'd be happy to assist if you're in the market for a new home. All my contact information is in the video description. Thanks so much. Have a great day.